Hi, it's Nero here from Investment Rise, and it's true. Some banks are increasing interest rates on some of their home loan products. So, does that mean that the property boom is about to end? Does it mean that prices are about to reverse and crash? Well, there are certainly some doomsday folk out there who will certainly say that's exactly what's about to happen. But today I want to talk about, what's driving these interest rate hikes and what it actually means for property prices going forwards. Borrowers urged to fix as more lenders hike rates. This from the Australian Financial Review. Borrowers are being encouraged to lock in part of their mortgage at a cheaper fixed rate as yet another lender hikes costs by up to 80 basis points for borrowers with smaller mortgage deposits. ING Bank, the nation's fifth largest lender, has raised rates on 1 to 5 year owner-occupied loans by between 30 and 80 basis points for borrowers with less than 10% deposit. There is no increase for investors. Now think about that for a moment. Our fifth largest lender is increasing the rates on home loans for owner-occupiers, people who are buying their own home or predominantly their first home with very small deposits. Why do you think they'd be doing that? Because primarily a lot of those people are perceived from a banking perspective as being a higher risk. So if rates do increase, if the RBA actually increases its cash rate in the future, I'll talk a bit more about that a bit later on, but if they do increase rates, the owner-occupiers who have bought homes with smaller deposits, which means their loan is a bigger proportion of the total purchase price, they present a bigger risk to banks. And you and I both know banks don't like risks. So what they're doing is they're increasing the rates for borrowers who they believe to be a higher risk. But did you notice that ING are not increasing the rates for investors? We'll talk more about that in just a moment as well, but let's get back to this article. By contrast, the bank is cutting charges for those with larger deposits. Rates for ING's Orange Advantage owner-occupier borrowers with at least 20% deposit are being cut by up to 25 basis points for 2-year fixed and 15 basis points for 1 and 3-year fixed loans. Rates on 4 and 5-year fixed products are rising by 35 basis points. There is no increase for investors. Westpac, the nation's second largest lender, is flagging the prospect of more rate rises with the launch of a fixed rate lock-in that allows a borrower to secure an advertised fixed interest rate for up to 90 days before their home loan is settled. It costs 0.1% of the loan amount. It follows CBA, the nation's largest lender, which lifted 3 and 4-year fixed rates this month, effectively ringing the bell on cheap rates and alerting borrowers to consider fixing before they move higher. A CBA spokesman said the changes reflect our long-term funding costs that have increased substantially and remain at higher levels after an extended period of low-cost term funding. And that's the problem. The Australian Financial Review actually doesn't explain it, but bank funding costs are increasing. Now, why? Well, it's the RBA. Now, no, the RBA is not increasing its cash rate. It's not even talking about increasing its cash rate. No way, not in the foreseeable future. But what the Reserve Bank of Australia is doing is they are winding up their TFF, or their term funding facility. Now, this was an emergency measure that was put in place during COVID. So effectively, what the RBA did was they lent money to the banks at an ultra low rate of 0.1% on fixed terms. All right, so you've got the rate that the RBA lent money to banks, which was 0.1%, but you've also got the cash rate, 0.1%. The two are actually different. All right, and now what the Reserve Bank of Australia has said that in June, i.e. this month, they are now winding up their term funding facility, which means that the long-term rates there, the funding costs for banks are going to increase. Okay, and so what you're going to see is the gap between the long-term fixed rates and the variable rates start to get narrower. Okay, so the variable rates at this stage are not going anywhere, right? But it's the longer term fixed rates that are going to increase. But are these interest rate rises bad for us as investors, right? Well, consider this. First of all, we have embarked, or the RBA rather has embarked on a money printing policy for the first time in history as a result of COVID-19. Right now, all those policies need to be wound back without stalling the economy. Okay, if and when rates do rise, and the RBA is still talking about 2023 or 2024 for when rates will rather be increased, it's going to be very slow and very gradual. Okay, so we're not going to see those steep rates rises that we've perhaps seen in the past. I'm talking, over 10 years ago, 20 years ago, those sorts of things. That's not going to happen this time, right? But yes, rates will rise, but they'll rise gradually. But what does that mean for us as investors? Well, according to this article, negative gearing will save investors from high interest rates, which means that the property boom won't end any time soon. Now, think about it from this perspective. As an investor, we get tax benefits, okay? And so when interest rates rise, we get an increased tax benefit because expenses have risen, okay? So that definitely cushions the blow for us as investors. But what else happens? Well, when interest rates rise, there are less people looking to buy property and more people looking to rent, which means rents rise, okay? And if, as I expect, these interest rate rises, whenever they do come, and we're still talking a good couple of years down the track according to the RBA, they'll be very slow. I believe that with the negative gearing benefits we get, plus the increases in rent, the impact will be cushioned, and I don't think you'll actually see prices start to slow, or rather prices start to reverse. What I think you'll start to see is, though, price growth will slow. So what does that mean for you as an investor? Well, again, this is not financial advice, but if you jump in now, if you can afford to, and you buy a property with the interest rates being at record lows, what you're going to see is, if you're buying in the right areas, prices will rise, you're going to get capital growth. Then when rates do start to increase at some point in the future, you'll probably see price growth, but at a slower rate. Prices are not going to reverse. If you buy in the right areas, they're going to keep rising, but at a slower rate. But then your rental returns and cash returns will actually start to increase as rents increase, because, as I said before, when interest rates rise, fewer people buy, more people start to rent. So as an investor, should you be concerned about rates rising? Not at all. And consider this, we're still talking about very, very low rates. We're talking about rates in 3% plus or 4% plus at the upper end. Okay, just a couple of years ago, people would have died for these kind of rates. Those rates were considered record lows. Okay, so sometimes as an investor, we need to have a bit more perspective. And secondly, we need to ensure that when we are investing, we do have these financial buffers in place. So we don't have to worry about what the latest headlines say. We have the right strategy in place. And if you're buying properties where the rent's already covering the mortgage, where vacancy rates are really, really tight, well then you really don't have too much to worry about in those kind of markets. But if you're over leveraging yourself, especially I'm seeing a lot of first home buyers are doing it at the moment, right? Then they are the ones who probably need to be concerned. But you as an investor should be seeing right now a huge opportunity to jump in now, get a good spurt of capital growth. I believe this next few years could be one of the last times that we see this level of significant growth, and so really that's why I'm encouraging everyone, if you can afford it, again, it's not financial advice, so check your personal circumstances, but if you can jump in and make some significant capital growth, but then you can hold on to the properties long term because the rents will cover the mortgage, giving you that passive income, that financial certainty that so many of us as investors are looking for. Hey, thanks so much for watching. If you found this video valuable and you're thinking you might like my help to help you find an investment property, then head on over to nerocall.com to discover our unique 5-step process that's helped my private client group purchase now well over $66.2 million worth of property. And then if you like what you see, you can book in for a half-hour phone consult with me personally. Either way, thanks again for watching.